Okay, a quick overview of the type of financing securities that we're going to talk about, and then we'll dive into each of those a little bit more in depth. Grants, as I mentioned, they are great because they're not dilutive. So nothing goes on your cap chart. You don't have to repay anything. A lot of people refer to grants basically as free money. Nothing is really free. There's always some kind of strings attached, but grants are a great option for early stage businesses. Equity, you've got preferred stock and common stock. It's pretty unusual to sell investors common stock, although it does happen. But it's far more normal to see investors buying preferred stock from early stage companies. We'll get into the details of preferred stock in a bit. Well, let's skip over and talk about debt. There may be an opportunity to use like conventional debt, but like I said, banks typically won't provide loans to super early stage companies. So convertible debt is a very common and usual way to raise your first round of financing. And then other types of convertible debt or convertible securities like safes. A safe is an acronym. They've been around for probably about 5 or 6 years. Several different flavors that we can get into, but SAFE is an acronym. It stands for Simple Agreement for Future Equity. There are or were other types of convertible securities around. I haven't. There was one I remember just because the acronym was funny. It was a KISS. It was a Keep It Simple Security. I don't remember who came up with that, and I haven't seen it in a long time. But safes are alive and well. We use those all the time on both sides of the deals that we do. Okay, so now we're going to dive into a few slides that go into a little bit more in depth on these different types of securities. Like I said, just keep putting those questions in the comments, and we'll get to those. So preferred stock, we'll start with that. The main concepts on preferred stock is that number one, there has to be a current value of the company in order to strike the terms of a preferred stock deal. So you might hear the terms like pre-money or post-money. The pre-money value of a company is just the value of the business prior to the financing closing. The post-money valuation is the value of the company after the financing closes. And ideally, the post-money should equal the pre-money plus the new money that's coming in. So you're going to have a valuation. A lot of people ask, well, how do we know, this is a super early stage business. Maybe you don't even have revenue yet. So how in the world do we know what the value of the company is? If it is that early, frankly, it becomes sort of a negotiation amongst the lead investor and the founders about, just a number. As a founder, you're going to want to try to, research your market, research your opportunity, come up with some reasonable, forecasts for what you think you can do. But, if you don't have any real detail yet, then you're really just talking about a number. And so there are companies out there that will do 409A valuations, that's something that becomes absolutely necessary later on. But essentially what it normally boils down to is, the founders and the board of the company taking all the information that they have into account, coming up with a good faith estimate, and then negotiating that with the investor and coming to an agreement. In all honesty, a lot of times what happens is the investor has a range of a size of check. Let's say they're going to write checks from $500,000 to $3 million, and they have a range of the percentage of the company that they want to own after the deal is done. And they agree on the amount of money they're going to put in. They agree on the percentage of the company they're going to have at the end. And then they kind of back into what the pre-money value of the company needs to be in order to make those things true. It's kind of backwards, but that is, at least in my experience, been reality many times. So talk about voting rights and protective provisions. Normally in a venture deal, in a preferred stock deal, the investor is not coming in and buying a majority interest in the company. that they're buying a minority interest, which typically, if they were buying common stock, would mean they have voting rights, but they don't have any ability to actually affect any change, which is one of the reasons why investors typically won't buy common stock. So with a minority investor who's buying preferred stock, they might have the right to put a director on the board themselves. The majority of the investors get to choose one director or more directors. And then there's other protective provisions around voting rights that would allow those investors, even though they're a minority, to have either consent rights over certain types of transactions or actions that the company takes, or maybe veto rights over the same things. You can't raise more money, you can't sell more stock, you can't borrow certain amounts of money, you can't sell the company. All those types of things are pretty normal to see in a preferred stock deal in favor of the investors. Liquidation preference is really it's a very common concept in these deals. Basically, the investors have some protection that allows them to get their money back, or it's usually a 1x liquidation preference, meaning they get the amount of money they invested in back before the common stockholders or founders get anything out of an exit. The non-participating or participating piece is kind of connected with the liquidation preference. So typically what I see is a 1x liquidation preference with non-participating preferred stock. And what that means is the investors have the right at an exit to choose whether to get their money back, or they can be treated as if they had common stock and share in the sale. And so they'll just do whatever's best for them. If it's a great exit, then they're going to be treated like they have common stock. If it's not so great an exit, they'll take their money back. That's typically the way I see it, but that can be, it could be more than a 1x liquidation preference. It could be participating preferred stock, but the earlier stage deals tend to be 1x non-participating. And then preemptive rights are basically the right of those investors to have to buy into later rounds. So maybe they have the right to keep their ownership percentage by continuing to invest as the company goes later and later into its path. Typical documents you're going to see in a preferred stock round are the restated charter that gets filed with the state, usually Delaware, stock purchase agreement, investor rights agreement, right of first refusal, and co-sale agreement and voting agreement. Those 5 are very standard. They're in almost every preferred stock deal. And then sometimes you'll see side letters or management rights letters or other things that certain investors will negotiate for specifically. In terms of the 3 types of securities we're going to talk about, preferred stock is the most complex. It costs the most to get it done. It takes the most amount of time. So that's kind of preferred stock in a nutshell. You could talk all day about preferred stock. There's a million different variations, and they can take a life of their own depending on what the negotiations are. So the next slide we're going to talk about is
Jesse, real quick. I wanted to pause there real quick if anyone has any questions on preferred stock, and then Jim here on YouTube's asking if there's any PDFs, maybe example documents that you guys have that you could send people. I know
Sure.
We're going to be sending out an email tomorrow for everyone.
Yeah.
If there's any, I don't know if you want to include some of these typical documents. I know you're going to get into the other types of rounds that people could get, but I wanted to pause there if anyone has any questions on preferred stock specifically.
Yeah, so the PDF, we will be sending out some additional information that, we've got a bunch of content on our website that's all free. You can download it, and we've got, more in-depth information about different financing types and stuff like that. In terms of form documents that you can look at, I'm going to put a comment in the section in the comments here.
Okay.
I think I can do that, or do I have to do it as a private chat? Maybe I do.
Yeah, if you do it as a private chat, I can move you over to get out on the social channels.
Okay, I just sent that out. There's a group out of DC called the National Venture Capital Association, and they provide most of the time when we're doing preferred stock, those are the documents we're starting with, because those documents are well known and accepted by investors and founders and lawyers and everybody else that are involved in these deals. So they're also annotated, which can be really, really helpful if it's the first time you've thought through some of this content. So throw that link up there. I would definitely check that out, because they're great documents, and those are what you're probably going to see.
Okay, fantastic.